Dividends are meant to comfort. For income-focused investors, MREIT's latest numbers are compelling. A growing rental base, steady cash flow, and distributions closely tracking distributable income. MREIT's portfolio expanded over the 9 months to September 30th, 2025. Revenues surged by 33% year-on-year, led by strong rental income and dues growth. All of this points to a business steadily converting office and commercial spaces into recurring cash flow, quarter after quarter. Profitability followed suit. Net profit reached nearly 2.9 billion pesos, supported by portfolio growth and disciplined cost control. Management highlights asset growth and expense discipline as the twin engines, even amid a temporary dip in occupancy rates. The results reflect a REIT performing by the book, expanding, earning, distributing. But that same discipline means the dividend's growth path is tied tightly to distributable income, after financing and lease-related costs. For the first 9 months, MREIT distributed nearly all its distributable income, leaving little slack for further dividend increases unless per-share income grows. Rising interest rates have driven MREIT's financing costs sharply higher, with interest expenses up due to a loan repriced from 3.6% to 6.5%. This narrows the margin between property yields and funding costs, making every peso of new income harder to convert into dividends. Lease-linked expenses add another layer. Rental rates tied to gross rental income have stepped up, and although temporary relief is in place, the long-term direction is clear. These costs will increase. If not offset by higher occupancy or rent escalations, distributable income per share may feel the squeeze. Yet, there are levers MREIT can pull. Occupancy stands at 92%, with some assets well below full capacity. Leasing up these properties can drive organic growth in cash flow per share. Asset infusions from the sponsor remain a potential growth engine. MREIT's planned share swap for additional properties promises scale, but the math must work. For dividends per share to rise, new acquisitions must deliver accretive returns after costs and dilution. Announcements alone are not enough. Investors should scrutinize the quality and economics of each deal. So where does this leave the income-focused investor? MREIT's dividend is stable, reflecting the structure and intent of a well-run REIT. But as the operating environment evolves, so too do the drivers of growth. Those watching closely should focus on 3 numbers: leasing progress in underoccupied assets, the management of financing and land lease costs, and the accretive impact of any sponsor-led expansion. In other words, the future of MREIT's dividend isn't just about yield, it's about mastering the math. In REIT investing, staying ahead means understanding not just what is paid out, but what drives every peso of distributable income per share. Because over time, it's that number, not headline assets or one-off announcements, that determines real dividend growth.